Hello, everyone, and welcome to episode 31 of JustDario Cigar Time. Today, we are diving into a fascinating comparison between Iceland and Switzerland. I'm sure many of you are already puzzled by these two names. What do Iceland and Switzerland have in common? Why is Dario dedicating a podcast to this topic? The reason, as I'll explain, is that Switzerland is increasingly positioning itself in a situation eerily similar to the one Iceland faced when the 2008 global financial crisis erupted. That crisis sent Iceland's economy into a tailspin, bankrupted its financial system, and left the country struggling to recover. Understanding Iceland's situation from 2006 to 2008 is crucial to grasping the risks Switzerland faces today. Let's start with Iceland. Before the 2008 financial crisis, Iceland's debt to GDP ratio was a modest 30%. It was considered a relatively safe country, not a major economic powerhouse, but with a solid backbone and robust financial services. However, Iceland's access to leverage became its Achilles heel. Starting in 1999, when Iceland integrated into the European banking system, the leverage of its banks skyrocketed by over 1,000% by 2008. Most of this leverage was acquired abroad. Why? After the dot-com bubble burst, central banks globally slashed interest rates to stimulate economies. Icelandic bankers, constrained by their smaller domestic market, but flush with capital, saw an opportunity. They decided to leverage their capital and expand into what were perceived as safe markets and asset classes, particularly the UK mortgage sector. This created a massive imbalance. Foreign funding for Icelandic banks dwarfed local funding. As if that weren't risky enough, when regulators in other countries began to limit banks' balance sheet expansions, Icelandic banks didn't slow down. Instead, they pivoted to their household clients, encouraging them to take on foreign debt and invest in foreign assets. Ordinary Icelanders, whose income and wealth were primarily in local currency, began borrowing in foreign currencies to invest in assets like mortgages, assets that later proved toxic, though they seemed safe at that time. At the peak, just before the collapse, the total assets of Icelandic banks reached a staggering 900% of Iceland's GDP, with a combined leverage ratio of 33 times. These numbers sound insane, but as I show, they're not far off from what some countries face today. When the crisis hit, everything unraveled. A bank run ensued, with depositors, mostly holding foreign currencies, withdrawing their funds en masse. Icelandic banks, heavily exposed to illiquid foreign assets, began dumping the local currency to repay foreign debts and stay afloat. This caused the Icelandic krona to plummet, devaluing by up to 80% against major currencies like the US dollar. The result was rampant inflation, peaking at 18%. In a desperate bid to stabilize the currency, Iceland's central bank raised interest rates to more than 15%. Despite these efforts, the economy spiraled, and Iceland required an international bailout, primarily led by Russian lenders and financial institutions. At the time, Iceland's GDP was about 18 billion. Today, it's roughly 31 billion, a modest recovery, but a stark reminder of the crisis' lasting impact. Now, let's shift to Switzerland. With a GDP of approximately 900 billion, Switzerland's debt to GDP ratio today is officially 18%, suggesting a strong, stable economy. The country boasts a 5.1% current account surplus, projected to reach 7.7% by the end of 2025, driven largely by service exports, of which banking services account for about 20%. On the surface, Switzerland's GDP doesn't appear overly reliant on banking, as financial services contribute just 10% of the GDP. The largest contributor following them are commodity trading for 8.5% and pharmaceuticals for 6.3%. This diversified profile leads investors to view Switzerland as a safe haven, a perception reinforced by the Swiss franc strength, currently at its highest in years against the US dollar. However, this strength has a downside. Switzerland imports many goods, and the strong franc is causing deflation. The Swiss National Bank has seized on this as a rationale to loosen monetary policy, cutting interest rates to zero to weaken the franc and stimulate inflation. This is the official narrative. Switzerland is fighting deflation and resisting its status as a safe haven amid global demand for its currency. But I want to take you beyond this facade of strength, which isn't so different from how Iceland was perceived before the 2008 crisis, albeit on a different scale. Remember Iceland's banking assets reaching 900% of GDP right before the global financial crisis in 2008? In Switzerland today, total banking assets are 500% of GDP, roughly 4.5 trillion for a 900 billion economy. Add to that the assets under management and custody by Swiss banks, and the financial system scale is a staggering, above and beyond $10 trillion. This reflects an economy with, yes, a lean public sector and low public debt, but an extraordinarily leveraged private sector, particularly the banking one. Let's be serious. Switzerland's wealth isn't primarily built on exporting watches or cheese, as some might assume. Instead, it imports capital and exports financial services. This makes its economy heavily dependent on global financial market dynamics. Strip away those capital flows, and Switzerland's GDP rests on shaky foundations. Despite its diversified appearance, with hundreds of local banks, a single institution, UBS, accounts for 40% of the banking sector total assets. UBS is a critical case study and is not even new to public bailouts. In 2008, it required a bailout after incurring a $50 billion in losses from misguided bets on subprime mortgages. Does any of this sound familiar? It should. Just over 2 years ago, I was one of the few voices on social media warning about Credit Suisse. With only a few hundred followers at that time, I relentlessly highlighted how Credit Suisse balance sheet was becoming increasingly illiquid, with assets not properly marked to market and the bank teetering on insolvency. When depositors grew concerned, a run on the bank ensued, triggering a downward spiral. The Swiss government orchestrated a last-minute bailout, changing laws overnight to merge Credit Suisse with UBS, overriding shareholders' rights and creating a financial behemoth. This choice kicked the can down the road, but effectively made Switzerland problems bigger and more complicated. Fast forward to today, and Swiss regulators are deeply worried. What a surprise, huh? They are demanding UBS raises over $25 billion in additional capital, citing significant potential losses in adverse scenarios. This isn't just me raising alarms, it's the regulators themselves. UBS is also attempting to mask its risk profile. And the evidence of this is the comparison between the structure of its balance sheet in 2008 and the one today. In 2008, the bank marked to market 21% of its assets, with only 16% held to maturity, means not subject to market valuation. Today, despite stricter regulations, only 15% of UBS assets are marked to market, while 28% are held to maturity. And that's a troubling shift for a bank that, in appearance, it boasts a strong capital with a core equity tier 1 of 14.3%. However, the real risk lies in UBS leverage ratio against core equity tier 1 capital, which stands at 4.4%. This means that if UBS assets values decline by more than 4.4%, the bank's capital is wiped out. Through accounting maneuvers, UBS is obscuring these risks, avoiding mark-to-market valuations as much as they can. As I have detailed in articles on my website so many times, the red flags of potential insolvencies of UBS are glaring, and there is little the bank can do to hide them anymore. The 2023 Credit Suisse bailout required UBS to merge with a failing bank, but only with assurances from the US Federal Reserve that liquidity facilities will remain in place for UBS American operations, alongside extensive support from the Swiss government. This was a chaotic situation, revealing Switzerland's limited capacity to bail out its oversized financial system. Again, a situation very similar to the one Iceland ended up finding itself in 2008. And if you think that UBS was the most alarming element here, I'm sorry, but there is more, because the most alarming element, pretty much overlooked by everyone, is the Swiss National Bank itself. Imagine a scenario where a major bank like UBS falters, and Switzerland lacks the resources to bail it out, clearly because its GDP is too small and strongly correlated to the performance of the global capital system. The Swiss National Bank, as a central bank, will be expected to step in using countries' reserves. However, its balance sheet, approximately $850 billion today, up from $100 billion in 2008, is heavily exposed to foreign assets. About 25% of it is invested in foreign stock, making the Swiss Central Bank one of the largest shareholders in major companies like Mac 7. Another 25% is roughly in credit, 30% in foreign fixed income. Only a small 5% is in low-risk reserves like gold. The Swiss National Bank is also a major derivatives counterparty in the global financial system, amplifying its risk even more. Considering this strong correlation with global financial markets, both on the stock front, but also on the fixed income front, it should not come as a surprise that in the recent years, the Swiss National Bank reported tens of billions in losses and was unable to pay dividends to the government, as its portfolio heavily relies on inflated asset prices. Asset prices, especially bonds, that due to increasing rates into foreign market, so their values decreasing more and more. But here, there is a very interesting thing, because despite what I'm describing, the Swiss National Bank is taking advantage of the Swiss franc appreciation, driven by foreign investors' demand that are seeking safety for the capital. As such, the Swiss National Bank prints currency, exchanging it for foreign one, and then this foreign currency is invested a lot in assets that bear a significant degree of risk. Rather than holding this foreign currency in low-risk reserves, the Swiss National Bank is effectively behaving like a hedge fund, although with a minimal capital buffer. This is a central bank behaving like a highly leveraged investment fund, gambling the nation's wealth on global markets. Once again, does this sound familiar? True, Iceland's central bank didn't engage in such practices to this extent, but its commercial banks did. And we know it brought to catastrophic results. Here we have Switzerland banks, in particular UBS, that are behaving like Icelandic banks back in 2008. But on top of it, the Swiss National Bank perpetrate a hedge funds-like behavior, effectively compounding the danger for the financial system and the stability of the country itself. Imagine a crisis hits. The Swiss National Bank exposure to volatile assets undermines its ability to stabilize the system. The Swiss franc could face a devaluation akin to Iceland krona back in 2008, potentially losing significant value once foreign investors realize that the Swiss franc might not be effectively as safe as they thought it was. This might sound far-fetched, but the data paints a clear picture. Switzerland is an over-leveraged economy, overly exposed to a deteriorating global market and global economy. Like Iceland in 2008, Switzerland's GDP is mostly built on financial services and capital flow, not on a robust industrial output. If capital flees, as it did during the Credit Suisse crisis, the economy could unravel. Raising interest rates to defend the franc, as Iceland did, would be challenging. Past attempts have already strained the economy, contributing effectively to Credit Suisse collapse and UBS precarious position. Countries like Turkey and Japan are facing similar problems, where rate hikes are failing to stabilize the currencies due to excessive leverage and dependence on volatile financial flows. In conclusion, Switzerland's situation mirrors Iceland's pre-2008 vulnerabilities a lot, but on a systemic scale that could disrupt the global financial system. I hope this episode has been eye-opening for all of you out there. Please leave your questions in the comments. I'll be happy to provide clarification and follow-ups. Thank you for liking my video and subscribing to my channel here on YouTube, for supporting me on X, and for reading and commenting my articles on JustDario.com. I wish everyone a great week ahead and a happy summer.